Imagine opening a software bill and finding a single charge for $500 million for 1 month. That actually happened this year, and it tells you something important. The biggest story in markets right now isn't whether artificial intelligence works. We know it works. The new story is what it costs and who ends up paying for it. Because that one question is quietly redirecting hundreds of billions of investment dollars, including, very possibly, some of yours. Welcome back to G-Theory. I'm Girish Navare. A respected research shop just published a State of the Themes look at where the AI trade actually stands, and it's one of the clearest explanations I've seen of a shift that's happening right under everyone's nose. I want to walk you through it in plain English. Here's my promise. You don't need to own a single tech stock for this to matter to you. If you have a 401k, an IRA, an index fund, anything, these companies are in there. So understanding where the money is moving is just understanding your own retirement. Let's get into it. Let's look at the chapters: the boom, the panic, where the money goes next, and what it means for you. First, the setup. For the last couple of years, AI has been the trade, not a good trade, the trade. Every corner of it connected to building these systems has gone up, and a lot. Earlier this year, the excitement hit a fever pitch. Engineers had a word for it. They called it token maxing. In simpler terms, everyone was racing to use AI as much as humanly possible, and the appetite for the hardware behind it went vertical. Look at this. This is the money poured into building and running AI each year. In 2019, it was about $74 billion. By 2025, it was over $800 billion. And this year, it's on pace to clear $1 trillion. The analogy I'd use, think of the California gold rush. Almost overnight, the whole world decided to start digging in the same field at the same time. When that happens, the price of shovels goes through the roof. In our story, the shovels were the specialized chips. And the value of the chip industry literally doubled in 2 months. So far, so good. Everybody felt smart. But here's the thing about crowded trades. In a matter of weeks, token maxing turned into something the report calls token panic. Let me explain what a token even is, because this is the whole ball game. When you talk to an AI, it doesn't read words, and it reads little chunks of words called tokens. Roughly, a token is about 3/4 of a word. And here's the key. You get billed by the token. Every question, every answer, every step the AI takes, that's tokens, and tokens cost money. Now, for a while, nobody felt the cost because the AI companies were subsidizing it, selling you $1 of computing for 50 cents to win your business. The parallel here is an all-you-can-eat buffet. Flat price, eat as much as you want, the restaurant eats the loss to get you in the door. Two things then happened at the same time. One, the newest AI agents, the ones that work autonomously, that reason through a problem step by step, burn through orders of magnitude more tokens than the old chatbots. So just as companies rolled these tools out to every employee started, without realizing it, running up an enormous tab. Two, the buffet decided to start charging per plate. This year, one after another, the big providers all shifted toward pay-for-what-you-use pricing. They simply can't afford to subsidize the heaviest users forever, especially with some of them eyeing the stock market. Put those together and you get the headlines. A company that burns its entire annual AI budget in 4 months. A consultant whose client got a $500 million bill. Because nobody set limits. Even one of the biggest tech executives in the world publicly grumbling that the best AI is extremely expensive. One CEO summed up the mood. Customers went from totally fine with what they were spending to suddenly asking, "Can you please make this cheaper?" Basically overnight. The free samples ended, the bill arrived, and the whole market is now asking the uncomfortable question, is this actually worth it? So what happens when people suddenly care about the bill? They go looking for a cheaper option that's good enough. And surprise, there is one. This chart is the one to remember. On the left, the premium American AI models. On the right, the cheaper alternatives. The cheap tier can be 10 to 25 times less expensive. Are the premium ones still better? Yes, but here's essentially what the question is. Why rent a Ferrari to drive to the grocery store when a Vespa gets you there just fine? For most everyday tasks, good enough is, well, good enough. At a fraction of the price. And this matters for investors in a very specific way. The market had been pricing the premium AI companies as if they'd have the road entirely to themselves forever. This reveals there's real competition now. In simpler terms, the question is shifting from how smart is the AI to how much value am I getting per dollar? And that's a harder question to answer. Now, this is the part people get wrong. None of this means AI is over. The report's actual conclusion, and mine, is the opposite. The AI trade doesn't die, it spreads. The money starts leaking out of the handful of giants and into the rest of the ecosystem. I'll show you the 3 places it's flowing. First, AI is moving out of the giant data center and into the device in your hand. The industry word is edge AI, but the analogy is the history of computers. In the 70s, computing lived in the mainframe. Then the PC, then the pocket. AI is making that same journey. Soon it'll run locally on your phone, your car, and the factory floor. And here's the kicker. A robot can't wait half a second for an answer from a data center before it decides whether to drop the box on your foot. Physical machines need to think locally. Second, and this one literally reaches into your wallet, is memory. AI is starving the world of a specific kind of high-speed computer memory. The chips that run AI gobble it up. Look at this. A few years ago, AI chips used a rounding error's worth of premium memory. This year, it's roughly a quarter of it. That leaves your phone fighting over the scraps, which is why prices for those everyday devices are climbing. The report calls it an AI tax, and you're paying a little of it whether you invest in any of this or not. So the industry is hunting for a workaround, and the leading one is to lean on a cheaper kind of memory called flash. Look at the cost gap. Flash is roughly 55 times less expensive. In simpler terms, if engineers can make the cheap memory fast enough to do the job, an enormous expensive bottleneck suddenly loosens, and those companies become very interesting. Third, the plumbing of the agent economy. Remember the gold rush? The reliable money was in shovels. As AI agents start doing real work, they need infrastructure. They need a phone network to place calls. They need identity and security, because soon companies may have more AI employees than human ones, and everyone needs credentials. They need monitoring. Somebody has to watch what all these agents are doing and what they cost. As the report puts it, you can't bill what you can't see. And eventually, they need to pay for things, which is why the big payment networks are racing to let agents check out on your behalf. They just want more activity. One honest caution, because I won't just sell you the upside. Lately, a bunch of stocks that got crushed by the fear of AI, the AI losers, have been bouncing back hard. Be careful. A lot of that is just what traders call a short squeeze, a quick mechanical bounce that has nothing to do with the business actually getting better. It's a dead cat bounce. Even something falling can pop up briefly on the way down. Don't buy the bounce just because it's green today. So let me bring this home. Takeaway 1. AI isn't a single bet anymore. It's splitting into the premium tier and a good enough tier. The easy money is getting harder. 2. The opportunity is spreading into devices, into memory, into the boring plumbing underneath the agents. The next chapter probably doesn't look like the last one. 3. And this is the one I'd tattoo on the inside of my eyelids. The moment everyone feels smartest is the moment to be most disciplined. Crowded trades reverse hard. That's exactly why our whole approach is downside first. We build portfolios that can participate in growth without getting wiped out when the crowd stampedes. Plan, protect, prosper. If this helped the AI headlines finally make sense, do me a favor and subscribe. I break down exactly this kind of thing every week.